Hello, we're going to talk about the divergence between the European and the US markets. On one side, we continue to see renewed highs in the US markets. Indices continue to break all-time highs, and what happens is basically that at the same time, consensus is saying that the market is too expensive, that there's going to be a very big correction, and what happens is that it doesn't occur. And why doesn't it occur? Basically, because everybody wants it to happen. More importantly, what happens at the same time is that the economy in the US is strengthening very clearly, despite the messages from the doomsayers. What we have seen is consumer confidence, manufacturing indices, GDP estimates, but also corporate profits. Corporate profits are much better after an almost very evident, actually, earnings recession. Corporate profits are being a lot better than expected. More importantly, guidance. Guidance is a lot stronger. To add to all of this, CapEx is building up. So these elements are helping to boost equity markets at the same time as a strong dollar is helping the US economy. The strong dollar is making the economy stronger. Why? Because this inflow of capital that's coming from emerging markets, etc., into the US economy is very positive as well for consumer confidence, because disposable income is stronger, and at the same time inflation remains subdued. So it's a good time to think about the strengthening of the US economy as an underlying factor that overrides those risks of tapering or rate hikes. In fact, if rate hikes continue as expected by the Federal Reserve, we believe that we will see an even stronger move into the equity markets. Now, in Europe, what we have is predominantly a negative combination of political catalysts, with elections in France, with elections in Italy, and a tremendous political turmoil in the country, with elections in Germany and Holland, etc. So the political landscape isn't helping. What is not helping either? Inflation expectations. Most of the inflation increase in the European Union comes from external factor, from food and energy. Therefore, it is not something that is going to help the economy get stronger. Actually, core inflation is not improving. So those two elements weigh on equity markets. However, earnings much better than expected, guidance much better than expected. Also, the fact that inflation is rising is putting pressure on the bond markets and bond investors. Therefore, we believe that being cautious and taking opportunities strategically and tactically is something that could be an interesting option for the second part of the year in the European Union. So we continue to be cautiously optimistic on equity markets. We continue to like the US, but we think that it's a good opportunity to start looking at the European Union. Thank you so much.